Welcome to the deep dive. Today, we're stepping away from the usual stock tickers and earnings reports. We're looking at something a bit more fundamental and, frankly, a little unnerving.
That's a big one.
We're looking at the rapid collapse of economic confidence on both sides of the Atlantic. We've been digging into reports from AP, Reuters, City AM, and they're all pointing to this singular reality.
A sudden and very parallel drop in the willingness to spend and invest.
Exactly, affecting both the United States and the United Kingdom almost in lockstep.
Yeah, and it's a fascinating puzzle, but one with huge real-world consequences. I mean, for anyone tracking the pulse of the global economy, these confidence indices are just critical.
We're not just looking backwards, right?
Not at all. They are vital leading indicators. And why is that? It's because they measure intent. And in our modern economies, personal consumption is, well, it's the engine. It's often 2/3 or more of GDP.
So when that engine sputters because people are scared.
Everything else slows down with it.
So our mission today is pretty straightforward. We're going to pull out the specific metrics that show this downturn, unpack the causes, which are surprisingly similar on both sides of the pond, and then figure out what this parallel slowdown might signal for, the whole global system.
We're essentially asking, what happens when two of the world's biggest consumers just suddenly decide to keep their wallets shut?
Okay, let's unpack this. We have to start with the behemoth, the United States. For years, the story has been about the resilient American consumer just defying gravity, but
Yeah.
the latest from the Conference Board seems to have delivered a bit of a gut punch.
It was a very sharp deceleration.
Hmm.
The headline number that grabbed everyone's attention was the index falling to 88.7 in November.
And just for context, that's down from 95.5 the month before.
A really significant slide, yeah.
I want to pause on that number, 88.7. I mean, historically speaking, that's not a deep recession number, is it? We've seen readings in the 60s during major crises.
That's a great point.
So is this just media hype around the number, or is the real story here the speed of the decline?
The speed is absolutely the crucial factor. You nailed it. When you look at the timeline, that 88.7 is the lowest level we've seen since April of this year.
So it's the steepness of the cliff.
It's the velocity of fear. That rapid decline over just 1 month tells us that the headwinds consumers were dealing with, that slow pressure, you suddenly turned into a storm right before the holidays.
And what fueled that sudden velocity? The sources must have some ideas on what specifically broke the consumer's nerve.
They do. We've really isolated 3 main drivers here. First, the perpetual elephant in the room. Persistently high inflation.
Right.
The pace of inflation might have slowed a little from its peak, but prices at the grocery store, for example, are still radically higher than they were a year or two ago. People are now facing some really tough choices.
And it's not all inflation, is it? Like gas prices might be a bit better, but the cost of housing or food is still just stubbornly high?
Precisely. People are managing fuel costs, but they're getting hammered by rent, insurance, staple goods, that non-discretionary stuff, and that just chips away at your ability to save or spend on anything fun.
Okay, so inflation is number one. What else?
Second, we're seeing clear signs of a slowing, or as the sources call it, a stalling labor market. The huge job growth we saw post-pandemic is definitely decelerating.
So even if unemployment is still low, people are getting worried.
Exactly. The anxiety is rising about job security, about wage growth not keeping up, and when people worry about their paycheck, the wallet just snaps shut immediately.
And the third one is interesting because it feels very specific to the U.S., but it has these real economic teeth. You're talking about the aftermath of that lengthy federal government shutdown.
Yes. Political instability translates directly into economic fear. The shutdown, even after it's resolved, it leaves this tangible feeling of uncertainty. It signals to people that the system might not be working smoothly.
And that just undermines faith in the future.
It does. People who are furloughed, they stop spending. And that effect lingers. It makes you postpone the big purchases, the new car, the kitchen renovation, all the things that really drive growth.
So we have an American consumer who is squeezed by inflation, rattled by politics, and now they've hit this 88.7 confidence floor. Now, let's pivot because here's where it gets really interesting. The UK is mirroring this, but the pain seems focused on a very specific economic artery.
That's right. In the UK, it's not just general household anxiety. It's specifically the health of the retail sector, the British High Street. We're looking at data from the CBI survey, the Confederation of British Industry.
And those CBI numbers are historic, which is never a word you want to hear in this context.
Alarming is an understatement. The survey showed that retailers' confidence fell to its lowest level in, get this, 17 years.
17 years.
17 years. I mean, think about that. That takes you back to 2007, maybe 2008.
Right in the middle of the global financial crisis.
So this level of distress among retailers is a huge historical warning sign. It suggests the core spending habits of the nation are just fundamentally broken right now.
We're not talking about a soft patch. This is structural panic. And you have hard numbers on this, right? It's not just a feeling.
Oh yeah, we have some crucial data points.
Yeah.
If you look at the retail sales balance, this metric tracks the difference between retailers who say sales are rising and those who say they're falling. That balance measured a terrible negative 32% in November.
Minus 32. So the vast majority saw sales fall, not just stagnate.
Exactly, and it got worse. It dropped even further from minus 27% the month before. The trajectory is steepening fast.
Wow. And what about looking forward? Are they expecting a quick bounce back?
The pessimism is deep. Approximately 24% so, nearly 1 in 4 retailers are predicting their sales will continue to decline next month.
And when businesses lose that much faith, they stop investing, they stop hiring.
It becomes a profound business crisis, not just a consumer problem.
So what does this retail weakness mean for the broader UK economy? Especially, you mentioned the timing earlier.
Well, it signals heavy immediate pressure. You get this vicious cycle of weak consumer spending leading to a halt in business investment. And you hit on the critical point, the timing. This is all happening just before they're scheduled to announce the new national budget.
That's right.
So UK policymakers now have to draft a budget to stimulate an economy where the most sensitive sector, retail, has completely lost its nerve. They can't just fix output. They have to somehow fix attitude.
And that similarity, the US consumer and the UK retailer both pulling back at the same time, that brings us to the synthesis, right? This isn't just a localized storm.
That parallel downturn is the defining takeaway here. It raises the stakes dramatically. If it were just one of these economies, you could maybe dismiss it as a domestic policy failure or something.
Sure.
But when both are seeing consumption seize up like this, it becomes this powerful indicator that global economic growth is under some serious threat.
And what does a seizure in consumption usually lead to? Is this just slow growth, or are the sources hinting at something more worrying?
Historically, a confidence drop this big often signals what economists call a stalling phase. Activity doesn't collapse overnight, but the momentum just fades completely.
And if that stall is allowed to continue,
The risk of a mild but widespread recession goes way up. And it's important to see what kind of risk this is. It's a demand-side risk. The problem isn't a lack of capacity, it's a lack of willingness to participate.
which puts the spotlight squarely on policymakers, doesn't it? Because if the problem is behavioral, if it's fear, how do you even design a policy for that?
That's the billion-dollar question. The sources suggest swift, targeted fiscal and monetary policy adjustments are needed, like now. In the U.S., the Fed might be under intense pressure to confirm the rate hiking cycle is over.
Just to calm the markets.
Exactly. To restore some calm, reduce borrowing costs.
And on the fiscal side, in the UK, for instance, where they're writing that budget as we speak,
For the UK, it's particularly challenging. They need to restore confidence in the high street. So maybe targeted relief, like temporary VAT cuts for certain retail sectors, or tax incentives for businesses to invest. The goal isn't just efficiency, it's restoring belief.
but I want to push back on that a little. If people are genuinely worried about inflation eating their savings, is a small tax cut really going to make them go buy a new TV?
That's a crucial insight, and it shows how immense the challenge is. If the root cause is structural, like global inflation, then a temporary fiscal fix is, it's essentially a Band-Aid.
A Band-Aid designed to boost morale.
You got it. Policymakers are playing a game of chicken. They have to appear decisive to calm sentiment, even if the real fixes take much longer.
So if these two major global buyers, the US and the UK, start to sputter, what does that mean for everyone else? You mentioned external markets, places like Vietnam. How does this demand shock ripple outwards?
Oh, the ripple effect is profound. Countries and businesses that rely on global trade, especially those exporting discretionary goods to the West, they have to track this stuff closely.
So it's a tough environment for manufacturing centers.
It is. A slowdown in the U.S. and U.K. means weaker demand for their imports, which pressures their exports, their supply chains. Plus, you can get significant exchange rate fluctuations as investors flee uncertainty.
So what's the practical advice from the sources for, say, a business in Vietnam that relies on Western consumers?
The key advice is simple but difficult. Flexible planning and risk mitigation. This is not the time for rigid multi-year plans. You need dynamic inventory management, adaptable staffing, ways to hedge against currency swings.
Adaptability is the ultimate defense.
When the world's two largest consumption engines are sputtering because of a loss of nerve, you have to be able to pivot fast.
This has been a really sobering, but I think a vital deep dive. Let's
Yeah.
just quickly anchor those key numbers one more time. In the U.S., the Consumer Confidence Index plummeted to 88.7,
The lowest since April.
driven by inflation and a stalling labor market. Meanwhile, in the UK, the retail sector's confidence has plunged to a 17-year low, with a retail sales balance of a painful minus 32%.
And the common thread connecting them is that severe erosion of the will to spend. Which brings us to our final provocative thought for you to take away.
Let's hear it.
We've talked about the need for effective policy, tax relief, monetary signals. But given that this issue is driven almost entirely by public perception, by fear and uncertainty, just how challenging is it for policymakers to design strategies when the problem they're trying to solve is public psychology, not just balancing a ledger?
A crisis of confidence demands a solution of belief. That psychological dimension is exactly what makes this moment so difficult. Thank you for joining us for this deep dive.